Welcome everyone to Vested Interest. This is Shane back again for our stock pick of the day video. It is November 5th. Today we're going to take a look at one out of the communications sector, Comcast. This may be who you get your internet connection through, or watch TV through, or have your phone service through. Let's jump right in. And if you are new to the channel or you just haven't done so, if you could hit that thumbs up, hit the subscribe button down below, join us on this journey to financial freedom, join the Vested Interest community, and hit that notification bell so you're notified whenever we put out any new content. That really does help a small YouTube channel like me. And drop a comment down below and let me know what you think of the video. Do you hold Comcast? Do you use any of their services? This is the Vested Interest Stock Screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I'm interested in investing. So that's what we're going to do. We're going to run through, understand the business, look at growing free cash flow over the last 3 years, really. But I like to go back 5 years and a little bit further than what we're going to look at today. We want a growing dividend over time, dividend payout ratio of 75% or less. This does not apply to REITs or business development companies or other companies, limited partnerships that might pay out more. REITs are required to pay 90% by law, so there are some legal ramifications to other companies. But for most qualified stocks, I like 75% or less payout ratio. We're going to check the valuation based on dividend yield theory to see if it is potentially undervalued. We're going to try to buy below current cost basis if it's already in my portfolio. If it is one I am looking to add, I try to do a discounted cash flow analysis on the company and then try to marry that cost whenever it falls within 15% of its 52-week low. Obviously, the lower the better. And I like to look at return on invested capital, return on equity. I like 10% or better, or in line with the industry average. And earnings per share growth, I like 5% or better, or in line with their industry average. And for companies like banks, I add in price to book. You can use price to book for any company, just don't use the one rule or lower, right? One being fair value, anything under one being undervalued, anything over one being overvalued. That is specifically for financial companies like banks. For other companies, you want to compare their price to book to other companies like them in the same sector. And it must meet 5 of 8 if it's a bank, 6 of 9 to be investable. Then it goes on my watch list. And like I said, I do more of a deep dive and look at it, put out a discounted cash flow analysis on the company, and then try to marry it to where it's within 15% of its 52-week low. So let's jump into the video and run through these criteria here for the Vested Interest Stock Screener and see if this one is presenting any value right now. So we are talking about Comcast, even though it says Xfinity down here, right? Comcast does business as Xfinity. So if you want to know more about this company, check them out at www.xfinity.com. That is www.xfinity.com. Comcast is a global media and technology company. From the connectivity and platforms we provide to the content and experiences we create, we reach hundreds of millions of customers, viewers, and guests worldwide. So again, provider of internet service, mobile phone service, entertainment, which doesn't just include movies, right? Movies, shows you're well aware of, but like NBC Studios, Universal Studios, I believe, they're all under the entertainment branch as well. So similar to Walt Disney, they have their own studios as well. So you could go to one of their studios, on a family vacation, ride the roller coasters, do all that sort of thing, just like you could for Walt Disney. So they have their arm in that as well as their internet, mobile, and entertainment arms. And they are global. So, right, they're not just an American company, they are worldwide, as it says here above. Now, the reason we are taking a look at them, down 0.49%, definitely not the biggest drop on the day for companies. There were some out there, Air Products, Partner Chemicals, I know, dropped over 15% today, so we may be looking at that sometime this week. But I wanted to cover Comcast Corporation, ticker CMCSA, today, again, out of the communications sector. Closed out the day at $44.87. 52-week range as low as $34.63, as high as $47.46. So they are actually closer to their 52-week high than their 52-week low. Average volume 18.1 million. Today's was 13.3. You can see that sell off throughout the day. Not a huge one, but sell off nonetheless. Market cap 178.217 billion, a beta of 1.0. So they are just a tick more volatile than the overall market. PE ratio, price to earnings ratio on this one, $12.09 per share. Earnings per share, EPS sitting at $3.71 per share. Their next earnings date coming out sometime between April 25th and April 29th. They have a $1.24 dividend paid out on the year, divide by 4, although we'll see that here in a little bit. Nice starting dividend yield of 2.75%. Ex-dividend date, April 2nd. And they will pay out on April 23rd. And 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $50.28. So they see it going up from here and setting a new 52-week low. See that? 47.46 would be the last 52-week low. They see it setting a new 52-week low. Now we're going to jump into statistics, look at dividend yield theory. To do that, if you were to go to Yahoo Finance, you'd click on statistics, you'd go down to dividends and splits. You look at their 5-year dividend yield average, 2.22%. You compare it to its current 2.75%, or over here where it says forward annual dividend yield, 2.75. That's the same number, right? 2.75. And since it is higher, since their current dividend yield is higher than their 5-year average of 2.22, that speaks to some undervaluation on this one. Not only some undervaluation, but undervaluation with a little bit of a margin of safety on this one, right? So that's good to see. Payout ratio is low, 31.27%, very low payout ratio. Lots of room to continue to increase this dividend over time. Now we are going to look at some of the financials. For our purposes, we're going to look at free cash flow, but there's a lot of good information under financials. You can see their balance sheet. You can see their income statement. You should be taking a look at their assets over liabilities. Are they paying down debt? Is their revenue growing over time? Are their margins growing over time or decreasing over time? You should be looking at all that information if you are investing in individual stocks. If not, if you don't want to do that, maybe ETFs or index funds are a better idea. But for our purposes, we're going to go into financials. We're going to look at free cash flow going back to 2020. So we're actually going to go back 4 years, not quite 5. But if you go to stockanalysis.com, which we'll see another source here in a minute, that's another source that I like. They go back much further. You can go back 5 years. I like to go back 5 years. So I look at the 4 years from Yahoo Finance, and then I go to stockanalysis.com and go back a little bit further. But 2020, they were at 13.1 billion in free cash flow, jumped up to 2021 to 17 billion. It looks like a drop down in 2022 to 12.6 billion, 2023 12.9 billion, and that looks like the same. So to date, 2023 here looks like they just probably closed out their year. Overall, it looks like decreasing free cash flow, at least from 21 on, but let's look at this. Repurchase of capital shares, only 534 million here, 4 billion. So look, 534,000, 4.6 million. So big jump up in free cash flow as well as repurchase of shares. And it looks like a drop in free cash flow, but huge jump up in the repurchase of shares. This more than covers that drop. So I would actually call this growing free cash flow because they're taking some of that free cash flow and repurchasing significant amounts of their own shares over specifically the last 2 to 3 years. So very good to see. That makes you more of a shareholder the more they buy back, even if you don't add any more capital to the position. Now, again, I always recommend more than one source. So another one that I like is stockanalysis.com. It has the same information. You can go back into the financials. You can go back into statistics. It gives you a forecast. That's what this is here. And I like to look at these. 22 stock analysts have taken a look at this. They call it a consensus buy, and it's getting close to a strong buy here. This would be a hold, a sell, a strong sell, and a strong buy. And if you were to go into stockanalysis.com, you could click on each one of these and see how many people of these 22 are calling it a strong buy, or a hold, or a sell. And I don't think there were any calling it a sell. They were all within the hold, buy, or strong buy criteria. Now, they have a low estimate of $44, and if it dropped 87 cents, that would meet their 44 low, a negative 1.94% decrease from where it currently sits. If it happened to hit their average $49.50, that would be a 10.32% increase. And they have a high estimate of $55, which is pretty close to what we saw on the previous slide from Yahoo Finance. And that would be a 22.58% increase. All the while, you could collect that 2.7% dividend yield. Now, I like to get into statistics on this one, and we're going to look at how efficient the company is reinvesting back into itself. Again, I like to look at return on equity, ROE, and return on invested capital, ROIC. I like 10% or better. ROE is sitting at 18.5, so that meets the metric there. And return on invested capital, ROIC, sitting at 9.61 is close enough to the 10% that I'm looking for. I would let that 0.39% off discrepancy slide, right? 9.61 is close enough to 10% for me. EPS growth sitting at 13.45%. What did we say we wanted? 5% or better. This smokes that number. And for a bonus here, revenue growth forecasted at 2.21%. So they are not looking to grow all that fast, but nice steady 2.21% growth over time. Now let's look at the dividend, and to do that, we go into dividends, right? See, the payout ratio is low, 33.42%. I think Yahoo Finance had it at 31%. Either way, in the 30s, very low payout ratio on this one. Quarterly payer, very nice dividend growth, 7.27% dividend growth on this one. They pay out in the January, April, July, October timeframe. So not a lot of companies pay out in this time frame. If you're looking for something that pays out in these quarters, this would be a good one to start looking at. April 6, 2021, they were paying out 25 cents. April 2022, they jumped it up to 27 cents. April 23, they jumped it up to 29 cents. And it looks like, again, in April, they are going to pay out another increase at 31 cents. Very nice dividend growth on this one. Very low payout ratio. It is a slow grower. You're not going to make $1 million overnight. But if you were to buy this one and this was continue, you would be beating inflation on this one every year, year over year. Very, very nice overall company. I like this one. A lot of people might think this is a dying company, but it is one I am looking to add to my portfolio. Well, that is really it. And to be honest with you, it's looking like a pretty good value right now. Obviously, I would love to get it cheaper than where it is right now. But I would say right now, you have a little bit of margin of safety, at least according to dividend yield theory. It is growing, nice dividend growth. And the company, even though it's a slow grower, it is continuing to grow over time. Looking at something out of the communication sector, this is one on my watch list. Let me know what you think in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit that subscribe button down below. Join us on this journey to financial freedom. Hopefully you are on your own journey as well. And drop a comment. Let me know what you think of the video. Is Comcast in your portfolio? Is it one you're looking to add? Is it one you're avoiding altogether? I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Comcast you'd like me to do a stock pick of the day series on, go ahead and drop it down below and I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice, counsel, or certified financial advisor.